Good day everyone, thank you for joining me. I am Tamara Kukshinovich and I'm going to take you through Growthpoint interim results. Growthpoint is fairly valued, trading at a 6% discount to its net asset value of 2,569.75 cents per share. The net asset value, including its listed investments at market value, is 2,827.56 cents per share. It has an attractive distribution yield of 8.8%, which is ahead of its peers and is guided to grow by 4.5% in the current year. The group is geographically diversified with exposure to South Africa, Australia, and Europe. Locally, property fundamentals are weak due to the depressed economic environment, and there is a lack of growth drivers. No growth is expected from South Africa due to the highly competitive environment, which puts pressure on margins. However, local earnings are expected to be sustained due to the quality and diversity of its South African real estate assets, combined with its investment in the V&A waterfront. Property fundamentals in Australia and Eastern Europe are more stable, and the group is well positioned for growth following the progressive developments and acquisitions. Management is planning to increase its offshore asset allocation to above the current 30%. Growthpoint Australia and Global Worth contributed 681 cents per share and 343 cents per share to Growthpoint's share price respectively. Locally, management is exploring opportunities to sell the 5.8 billion rand in local assets, which will probably be recycled into higher quality assets. With a loan-to-value ratio of 35.9%, management feel they are well positioned given the strong balance sheet. We feel the above-mentioned concerns are fairly reflected in the valuation and would recommend a neutral position in the counter relative to the benchmark. Moving on to the financial highlights, revenue increased by 4.3% to 5.7 billion rand. The property expense ratio increased to 22.7% from 21.7%. Finance costs increased by 5.6% to 1.4 billion rand. And finance income increased by 93.1% to 695 million rand, which was mainly due to the Global Worth dividends. Headline earnings decreased by 17% to 2.4 billion rand, which includes the revaluation of properties. This was mainly driven by the positive property fundamentals in Australia and a slight decrease in South Africa due to low growth resulting in economic weakness. Distributable income increased by 5.9% to 3.1 billion rand. The interim dividend increased by 4.6% to 105.8 cents per share, which was in line with the market guidance. Distribution for the past 12 months amounted to 213.2 cents per share. The property portfolio increased by 2.8% to 115.5 billion rand, and the net asset value decreased to 2,569.75 cents per share. Nominal borrowings increased by 5% to 49.7 billion rand. 35.3 billion rand and 14.5 billion rand is attributable to South Africa and Australia respectively. 85.6% of debt is fixed with a weighted average interest rate of 9.1% and a weighted average maturity of 3.4 years. Growthpoint has unused committed bank facilities of 5.1 billion rand in South Africa and 2.5 billion rand in Australia, which ensures that short-term commitments can be met. The consolidated loan-to-value ratio increased to 35.9% from 34.5%. In conclusion, we would recommend a neutral exposure relative to the capped SWIX and the All Property Index. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. A comprehensive company analysis report on Growthpoint can be found on the PSG online trading platform. Before we end off, please take note of the following disclaimer. Thank you.